Price action and candlestick patterns. Price action refers to individual or groups of price bars or candlestick patterns. Price action is raw, it doesn't use indicators and gives immediate clues as to the likely market direction. Remember, all indicators lag by their settings. If indicators are a newspaper, then price action is CNN. Price action relies heavily on strong candlestick patterns like pin bars and engulfing candles. Look for confluences of price action factors such as candlestick patterns at clear support or resistance levels in the direction of the dominant trend. Let's have a look at the pin bar. So, pin bar candlestick has a short candle body at one end and a long tail or wick at the other. It's also known as a high or low test bar, hammer, hanging man, long-legged doji or gravestone doji, that depending on which side the tail is and to a certain extent the size of the candlestick body. It's a very powerful price action trade setup. The candle indicates strong rejection of price level, and that's where the wick or the tail is bouncing off or rejecting that level. It needs a clear support or resistance level to bounce off for best results. It's also better when the trade is taken in the direction of the dominant trend and the setup works in any market or time frame. Let's have a look at a schematic of the setup. So here we have a clear resistance level, so resistance, 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 we break through and that resistance level now becomes new support and our pin bar candle is formed at that point. The entry, or the classic entry, is on the break of the high of the candle, with the stop loss going beneath the low of the candle and also the support area. Once the trade triggers, it should move off in the direction of the dominant trend for good profit. Here we have a chart of the GBP USD sterling, and we've got a clear support come resistance level. So as we come down, it was support, it breaks through, and that support turns into new resistance on the other side. And here is our pin bar. So we've got a nice long wick rejecting that upper level just short of 1.68. We can then take the trade on the break of the low of the candle, moving nicely down to 1.48 for some solid profit. On the Dow Jones Industrial Average chart, we've got a resistance level that breaks through to form new support, and we have two pin bar candles forming, both of which, on triggering, would have moved us nicely in the direction of the dominant trend and for profit. Moving on, a new resistance level is then formed, and on the other side, once it breaks through, a new support level, and yet another pin bar, which in turn, if taken, would move upwards for profit. In conclusion then, candlestick patterns and price action work much better when trading in the direction of the dominant trend, as is the case for pretty much all setups, taken off clear support and resistance to provide that bounce environment. The pattern is a major or well-known one, such as a pin bar, which everyone is going to see and the market is going to react to accordingly. And finally, the pattern or price action is very clear or exaggerated to really get the message across to traders as to what's happening in the price action.